Good morning, ladies and gentlemen. Today is November 6th, Sunday, early in the morning. The rotational modeling, this is the rotational modeling system and real estate video for all of you to follow what's going on and pay attention to how the trending sets up. So right now, the rotational modeling system, just like the markets, have moved into kind of a sideways flat trending. Nothing has really changed with regards to the daily and weekly trending. Nothing has really changed with regards to the allocation levels. We have the primary allocation levels here. We have the alternate allocation levels here. You can see we're mostly in cash with a small percentage in metals if you have this primary allocation table set up, or mostly in cash and very small amount in stocks. This gives you an ability to trade a small amount of your capital into stocks using my live trades or my TT scanner algos. Gives you an opportunity to try to find triggers as they're setting up, keeping you active in the markets while you're holding on to cash and metals as a primary hedge against the risks involved in the market. As I've gone over the market setup right now, we are seeing some early stage basing bottoming, potentially setting up a reversion trade to the upside. We'll see how that plays out over the next couple of weeks. Of course, the Fed came out and raised interest rates again. We have the elections coming up this week. Could be a very volatile week. So stay safely protected. Make sure you are using proper allocations if you are trading any stocks, and we need to kind of just wait this out for a real confirmed trending direction. Okay, so now we are going to move, oops, wrong direction, to the update. This was updated through the end of October. I update this at the end of every month. You can see the 2022 number decreased a bit. We were at 4.72, I believe it was before. Now we're at 6.26. Still moderate sideways trending compared to what the S&P has done. And you can see here the current position of the rotational modeling system is weekly bullish, which is 25% if you have two accounts. Daily bearish at 75%. We are up 17.85% on the weekly trigger and up 5.9% on the daily trigger. Combining these into a single account position, you would be 50% bearish, indicating a 5.9% gain from the trigger, which triggered an 8/31/22, and you would have 50% cash since 8/31/22, about 4 months ago. Understand that that would have gained a little bit because of the US dollars rally over the last 4 months. So you would have been very well protected. Now, what we're looking for, ladies and gentlemen, is we are looking for the SPY to move away from this daily bearish, weekly bullish standing into either bullish bullish or bearish bearish, and that'll put us into a confirmed daily weekly trend bias, which means we will now be allocating 100% of our capital into either an uptrend or a downtrend, and I believe we may see that happen before the end of this year. If it stays just the way it is through the end of the year and we don't see any real activity, we'll likely continue to stay in this trend, in this bearish daily, bullish weekly type of trend, keeping the same allocation levels, staying properly hedged, and keeping the same type of position here. Eventually, the markets are kind of flattening out near these lows right now. We may see the daily flip back into bullish trending, but we haven't seen it yet. And if that's the case, then we will go into 100% bullish allocation. We will start running the target levels as they come up, and we will execute the trading system a bit more efficiently to the upside. Right now, for quite a while, we've been rolling into this bullish bearish daily cycle, mostly bearish since the beginning actually of 2022, and it's kept us very well positioned. Remember, when you look at the graph here, you can see the S&P is down, 20, 25, 30% in our trades, and our rotation from 2021 into 2022, we're off only 6%. So we've protected ourselves very well with the rotational modeling system. We're just looking for that next big trend to take off. Okay, the real estate sector is right here. We got data just last Thursday. You can see here with the yellow line that the price reduction count is back up near 100% again. Pretty much everything on the market right now is being reduced. You can see the active listing count. This orange line is moved higher. You can see the dark blue line behind this gray line is coming down. That's the pricing, median listing price factor. So we're still positive year over year, but it's coming down a lot more aggressive. I think this is going to move into negative territory into next year. I really believe the Fed is trying to take the wind out of this. You can see from back over here, COVID. Yeah, we had moderate increases, 8, 9, 10% in 2018, 19. They were willing to deal with this simply because they were trying to spark some sort of an inflation move. Well, COVID did that for them. It sparked the inflation move. Everything shot up. Inventory tightened. You can see down here, active listing count dropped. That's the orange line here. The price reduction count dropped considerably. This is everybody's raising prices. This is where everything shot up in the housing market. Prices went skyrocketing. Inventory decreased. Buyers were buying at 10%, 15% over listing price. Everything seemed rosy until everything shifted in June 2021. And all of a sudden we started seeing a weakening market, and now we're in a point where everything that was the below zero over here, the gray line, the orange line, the yellow line, have now pretty much moved all above zero, which is right over here. And this means that reductions are at 100% of the pretty much the market. Everything is being reduced. Active inventory is hitting the market, which means more foreclosures, more people trying to get out of the market. We've got days on market staying relatively high. We've got this is median price or price reduction share year over year has turned positive. So now you're in a scenario where we're seeing more reductions than rising prices, and we're seeing price levels decrease. The custom modeling system that I created shows that real estate price factor is minus 35.66, down 2.992 last week. And modeled market demand is minus 29.63, down 1.989 last week. But you can see how the demand cycle was excessive back over here. Okay. I mean, this was a huge demand cycle coming up as pricing was still continuing to elevate. And you can see that's right over here. Okay, that's in this April, May, June cycle. We were getting a bit of a demand cycle. Prices were going up. Reductions were still there. People were still buying, thinking, oh, this is a great time. I can still get into the market before the Fed raises interest rates. Now the Fed has raised interest rates considerably. Demand has dropped from plus 140 down to minus 29, almost minus 30. It's been lower. It's going to go lower, in my opinion. This is going to flatten out down probably at 50, minus 60 over the next, throughout 2023. It's going to be a very ugly, interesting time. I think I have to go this way. The U.S. market price trends have flattened out. This is a longer term picture of price trends. You can see we had price trends elevate, elevate, flatten. We're now down into a moving lower cycle. We've kind of flatlined here at moderate upward price trends for a little bit. Things, if we look back over here, you can see that price trends kind of flattened out. They gained a little bit here in demand and price trend factoring. Now we're moving back lower. That's being represented here, moving back lower. Price reduction counts have shot up. Price reduction activity has shot up. Active listings have shot up considerably. This was a very tightening market. Now we're getting a lot of listings coming in the market. A lot of foreclosures, folks. People are going to be, you're going to see massive amounts of foreclosures, and it's a very early in the cycle. So it kind of reminds me of like early 2008, not 2011 and 12. The bottom of the cycle is going to see active listing counts way up. It's going to see price reductions way up and price levels way down, possibly 25, 35% below where we're at right now, maybe even lower in some areas, depending on what happens. New count listings, we have here new count is at a new high. Look at this going all the way back to 18. We've never seen New count listings up so high at 40%. People, that means that inventory is flooding into the market, trying to get out of the market, and it's very, very early still. This could go up quite a bit higher. New count change is 0.19, and new count share of market hasn't changed. That's the orange line, or sorry, the gray line is flattened out. So understand that this is, again, a modeling system. New count index is 40.4 compared to where it was back here just about a year ago, minus 59. So we're seeing homes flood into the market. And I'll bet you 6 months from now, this is going to be way, way up here near this 50-60 area. Okay, lastly, we are going to look over here. This is my newest modeling chart. Kind of interesting playing with these modeling systems because I get to give you insight into things that most people don't even know. So understand that the heat rank is a measurement of how hot the market is. Okay, and this is a measure of how much inventory is coming in the market, how much real activity in a price factor and inventory is coming in the market. So you can see we got a lot of inventory coming in the market. We had a little uptick last week. We had seen some flatlining. Then we had a little bit of activity here in June, July. And that was, again, a flood of inventory, and then it started tightening out. Now we're getting a bunch of inventory coming in. You can see the U.S. real estate tightness rank is very weak. That means that we're getting a lot of activity, a lot of homes coming in the market, a lot of price reductions. People are trying to dump their homes if they can, possibly moving into smaller areas, possibly moving into motorhomes, who the heck knows. But we are not seeing a tight market right now. It's very loose and it's very fluid. People are trying to dump inventory as much as they can. It could be the Airbnb investors or BlackRock or Zillow or whoever, but it is a very, very loose market. We haven't seen this type of a loose market. In fact, this is the lowest it's been in the past 2 years, and it's probably going to go a lot lower. Real estate inventory strength. This is a measurement of how strong the inventory is. Think of this as a very high demand. You buy something, a house, and it increases in price because there's a strong demand upward for price activity. You're seeing now a very weak trend. You're now at minus 6% inventory strength, almost 7%. We haven't seen this in the past 2 years. Nothing has been this low. Yeah, we've gone up and down 3 or 4% at various times, but nothing is minus 6%. And we've just seen this really start to kick in. Remember, this last year, the Fed has raised interest rates aggressively. House markets have yet to reflect this. The housing market is now starting to reflect the fact that downward price trends are being priced into the market. And then, of course, you have seller desperation right now. Seller desperation is down right now. You're not seeing a huge amount of seller desperation. You have the heat rank at 1.76, which is a little bit positive. It's probably going to stall out. Might go a little higher, but eventually it'll stall out. Tightness index is minus 17.37, which means that we are at the lowest levels. This is lowest levels we've seen in forever. And inventory strength is 0.59. This is week over week change, by the way. And then we have seller desperation is minus 67.42. So understand that we're not seeing a broad seller desperation yet. We will likely see this kick into gear as things start to really become more liquid. Just please understand that what all of this data is showing you is that prices are going down. Investors are starting to hit the market with a little bit more aggressive nature to try to get out near these current highs. We're not seeing extreme desperation yet. We are seeing excess liquidity, not a very tight market. It's loosening up. It's almost like getting into a buyer's market again. You know, if the house is listed at 400, name your price at 350, 325, see what they say. And inventory strength is dramatically lower. Inventory strength has gone down, which means the actual demand, the ability for you to price your house at what you want has gone down. Now there's starting to become a real chase to the downside. How low can I go before I can get somebody to pay attention and actually start to buy it? So it's kind of interesting how this whole dynamic has shifted. We've really seen this big bump over the last 4 or 5 months in price reductions. Everything has turned positive. We've seen that the listing has rolled positive, negative, positive, negative. It's back going headed to the upside. The actual price trend strength is weakening. I expect it to move downward. And then you have this new count metrics is kicking in. We haven't seen houses come on the market like this in a long time. In my opinion, this is just the beginning of it. So understand we're only 3, 4 months into this, and it really depends on what the Fed is going to do. If they're going to push mortgage rates up into the 7, 8, 9 ratio, which we're close to 7 right now, I believe. But the long and short of it is if they push it up into 8, 9, 9.5, you're going to find some people really freaking out. I mean, really just diving for the exits if they can't make their mortgages. And God willing, if we get into another layoff scenario, what that's going to look like, because that could send a whole flood of foreclosures into the market, kind of like 2008, 2009 all over again. So pay attention. We're very early with this stage. This would not be based on my information here. I would not be looking at REITs or anything investment related, given what's going on with the Fed and the market right now. It looks extremely fragile. All right, guys, we're going to go on to the next one, which is the TT Scanner hot list.